From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, March 5th. You are listening to the Macrocast. This is Tony Fratto. It's Jobs Day. We have Matt McDonald here with us from Hamilton Place Strategies. Our usual partners on the Macrocast, John Fagan and Brendan Walsh from Markets Policy Partners. Guys, we got the jobs numbers today. It was a really good number, and I think the way I just said it was I don't see any dark clouds here. I just see silver linings. That's all I'm paying attention to right now. You could probably dig really deep. I don't know, Matt, if take us through the numbers, but I don't know if you see anything that gives you pause. I think it's all good.
Yeah, no, the numbers are great. It's headline 379,000 jobs created. The unemployment rate ticked down from 6.3 to 6.2. There's no, the underlying dynamics of that unemployment rate are driven by more people getting jobs. There's no kind of like dropping out of the workforce. There's no like weird population stuff like we've seen in some months. So all good. The big driver of jobs is 355,000 jobs increase in leisure and hospitality. You saw a slight decrease in government jobs, which is kind of interesting. There's a little bit of caveat around some of the February storms, but this is just a really good number. It's a very interesting number in that we've been talking for a few months about, when we were in the zone of like the jobs aren't really going to get better until the pandemic gets better. And to me, this number indicates kind of the beginning of the end, right? We see not the end, but the beginning of the end. We see, I would have expected this number candidly in March or maybe even April as vaccine rollouts continue and the pandemic kind of tapers off and works through the population, candidly. But to see this number in February is a pretty big boost. I think that it confirms, to me, this number confirms views of 2021 as a very robust economic year. I think that I don't see a reason why, we'll have some ups and downs, but I would expect for robust numbers like this to continue for the months to come.
Yeah, I mean, to your point on it, seeming early, as say, states are probably going to, reopen with what we're seeing with the vaccines. But even the states that have announced dramatically, Texas, Mississippi, Alabama, have all announced. Connecticut also.
Connecticut's moving to, I forget what the date is. It's like mid-month.
Yeah, it's mid-March.
100% capacity.
But they haven't announced those. I mean, they haven't actually been put in.
They haven't done it yet.
That's right. That's why I would have expected something like this for the March numbers. The fact that it's in February, pulling that forward, and it's that good.
And we had bad weather all February. So
yeah,
the fact that it was heavily driven by restaurant jobs is a great sign for the future.
Yeah, it is a signal. I mean, I think just thinking about New York, I'm just anecdotally, New York did go to 35%. It was like edging larger, and you repeat that, a few 100,000 times throughout the economy of, restaurants here and there adding an extra busboy, an extra waiter, an extra back of the house job. It adds up across a big economy, and it seems like that's what we're seeing in whether it's hotels and restaurants and other service-related jobs that people were afraid, or and I think more afraid than even government policy of having economic activity, and it seems like those are the signs that we're seeing.
Yeah, I mean the
caveat as a sign of what's to come. So Bank of America's credit card data, they break it down by age. So 70 and above saw a massive spike in airline bookings. But they didn't see also a huge in the hotel. So either you're coming to your winter house in Florida or you're going to visit your family. But most importantly, people that are vaccinated feel safe to get on a plane. Yeah,
the caveat to all this is that we still have we still have some digging out to do from the impact, but it strikes me that we're now kind of fully on the right trajectory. The pandemic's going to get better over the coming months. The jobs are going to get better over the coming months. It's all pointing in the right direction.
Exactly. The private sector data from this report was incredibly surprising to the upside. The problem is the state and local government data continues to be incredibly weak, and it's basically entirely in education. So we lost another almost 70,000 jobs in state and local education, which brings it up to about 1.5 million teachers and support staff that have been laid off throughout the pandemic. These are people that need to educate our kids that aren't going to be there when we come back.
Yeah, it's I'm married to a public school teacher, so I don't minimize that one bit. It's until schools are opening, I'm not sure, it's probably not subject matter teachers, right? It's probably gym teachers and the driver instructors and the superintendents, the janitors, cleaning staff, all of those folks. Got to get those schools reopened for a whole lot of different reasons, for those jobs.
And there is a lot of money in
so parents can focus on work, and so that kids can get better education in the school.
And I think that the Biden administration made a push this week for that. I think it's really important to get kids back in school. The San Francisco Fed did a study that said us keeping our kids out of school this year, where the rest of the world sent them, will take 70 years for us to rebound economically from that choice. But I also think that parents are kind of at their wits' end. And I think the Democrats realize that getting kids back in school as quick as possible is going to be what people vote on in 2020.
Yeah, I think they definitely see it as a political vulnerability.
It'll be a bloodbath in the primaries if kids aren't back in school.
Yeah, getting back to the jobs report, and again, like I said, I am focusing on the silver linings in the report because I think directionally everything is going in the right direction. Levels were obviously still way off, and not just
we're still 12 million jobs shy of where we were.
Well, I think we're at maybe 10 or 11 million shy of where we were. We're probably 12 million shy of
where we should be.
Where we ought to be if we continued on trend job growth. We still have a lot of ground to make up, and that's just to say that, and it's taking Matt's cue on this of this number. I don't know that it's going to be a steady line, right? A straight line. Sort of linear kind of increase. It may be spiky. We may have a huge month and then a drop off. That's possible.
You would have to imagine that the summer months could be massive.
I think we could see some massive, 2, 3, 4, some massive increase. Like things that we've never seen in the same way we saw job losses that we've never seen before. I think we may see some job increases that we've never seen before. 1.2 million jobs in a month, that kind of, those kinds of numbers that were unimaginable pre-COVID. But I think we could certainly see that. People are looking at today's numbers saying, well, at 350,000 jobs a month, it's still going to take us 25 months to get to I don't think we're staying at this state, right? I think once we get into spring, once people are, as we've talked about with vaccines and as this reopening happens, I think you're going to see massive job number increases on a month-to-month basis.
Yeah, that's
I see help wanted signs all over the place.
I started this by saying I would have expected this number in March or April, and it's possible that this is the bad number.
Right. Yeah.
I think you're right.
You may have to you may have to elevate your expectations for March and April.
Yeah. Especially now that if the administration was comfortable enough to say that everyone can be vaccinated by the end of May, it's May. You don't make that promise and not fulfill it. So,
well, I think you make that promise, and it's probably April.
It's probably April. Well, especially because of the amount of a lot of people aren't going to want it, and it's going to take us a little while to convince those people. So yes, everybody that wants a vaccine, I think, will be vaccinated by the end of April.
So, I guess, there is the long-term unemployed in there. Any other, Matt, anything else out of the number that we should be, paying particularly attention to? It's our workforce participation. Again, direction.
The BLS did put a point. So the amount of people that had to drop out of the workforce to take care of their kids, the unemployment rate should be 0.5% higher than what it is because of the way you have to answer the question. But they put that's been the case every month for since this has began.
John, what are markets saying?
Well, this is a very, very encouraging reaction in financial markets. We've seen this dynamic over the last few weeks that is a little bit paradoxical to the person on the street, where good news is bad news, and good news about vaccines, good news about the economy, good news about the recovery, this tantalizing post-pandemic premonition that we're having in financial markets and in our own personal lives has actually created some difficulties in financial markets. It's created some real churn. We've talked about this before. The rotation in stock markets from the high-flying pandemic winners, Zoom, Peloton, Netflix, to the more growth-dependent kinds of sectors of the stock market. Energy, materials, industrials, these are less whiz-bang, less magical than some of the Teslas of the world, but they're the ones that have been outperforming the small caps, the Russell 2000s. And what we've seen is, there's clearly pain in portfolios on Wall Street and in hedge funds and so forth, and in pensions and 401ks. Real people are losing money in this because they were in some of these stocks, and those stocks have really led to the upside. But it's coincided. It seems to be this is the kind of thing that, based on what Chair Powell said yesterday, it's not lifted Treasury yields, longer dated Treasury yields, to the kind of levels that would really freak out the Fed. Yeah. We are up at 1.5, 1.6 on the 10-year. These are not nosebleed levels. It arrived quickly at these levels. That's the problem that the Fed speakers have keyed in on, the pace. But when you see an upside reset like yesterday, that's a little bit concerning, but it was only 7 or 8 basis points, which in the grand scheme of things isn't a killer. And the reflexive move higher today brought the 10-year, basically 5, 6, 7 basis points higher to 162. Mm-hmm. And now it's settled back down to about 158. This is a process of the 10-year finding a more realistic equilibrium. If you're sitting at the Treasury and the Fed, and you had, a couple of months ago, if you had a wish list for things to happen in the market, you would want the Treasury market to reflect better growth expectations, but in a gentle and non-volatility creating way. You would like some of the froth to get blown out of parts of the equity market. And you would probably want the more growth-oriented stocks to outperform. You would probably want the dollar to stiffen up a little bit. And these things would dampen the inflation expectations, but they would actually allow you to keep a very, very accommodative monetary policy, because the market is doing some of the tightening for you rather than too much tightening. So right now, we've been sort of joking that this is been the immaculate, from the perspective of policymakers, this has been the immaculate correction. I mean, this is exactly kind of what they would want to see. And surely there's a risk that it goes too far, and they're obviously watching it. But I think Fed Chair Powell emphasized yesterday that what they're seeing right now isn't scary to them.
John, I have a question. I look at the policymaker side of the equation here, and I see just a lot of conviction, both on the monetary side and the fiscal side, about what the direction is and where they should be going. And it's interesting, and we've had conversations on this in the past. It's an interesting environment where it feels like because of that conviction, the markets are not leading the policy. And so they're being forced into a little bit of a response of, okay, whatever we do, this isn't, we need to calibrate against the policy, as opposed to factoring in uncertainty that the policy may change depending on what the markets do. what's your take on that dynamic and what we're going to see on that unfolding?
I think that it is different on the fiscal and monetary sides. I think on the fiscal side, it is basically a, straight ahead. They are going to rush forward on this bill rush. They're going to proceed forward on the 1.9 trillion rescue package, the investment package, the Build Back Better American Recovery Act. We expect to be a similar size. We do not expect the market or any other aspects to really knock them off the line. The Biden administration has two big levers to pull in their first, before the 2022 midterms. And these are those two levers. And they want to leave the Republican Party in the dust here as much as they possibly can. And this is how they aim to do it. So there's not just an economic, but a political imperative driving the fiscal moves in our view. On the monetary side, we see this as much more like much more tactical and much more of a dialectic with markets. This is kind of a fighting retreat for the Fed. They want to be able to calibrate their policy for the most damaged parts of the economy and be able to hold that policy as accommodative as possible for as long as possible. But they are clearly acknowledging that the market is going to have its say, and the market is flashing forward to this exciting growth future that we all hope we have and we think we're going to have. But the act of flashing forward to it, if you take it too far, that can actually undermine by virtue of the expectations getting too far ahead of themselves, you can actually undermine the recovery by longer dated yields running up too far. So the Fed, I think, is trying to calibrate their communications. If you ask them, in their heart of hearts, is there guidance for no rate hikes before 2024? Is that rock solid? That's, a really long time for guidance, but there's a use for that. And it's to try to keep markets on side for as long as possible. And if the recovery really is great, we do expect the Fed to be responsive to that and pivot. But they've got the rhetorical and analytical background to say, we're not going to overreact in the short term to, a snapback in inflation and growth, because over that hump is going to be a much more normal kind of environment.
Yeah. And in fact, Powell yesterday in that interview with Nick Timmerhouse he's predicting it, right? It's not just whether it might happen. He's essentially saying there will be a temporary increase in inflation. We're not going to be fooled by it. He's essentially saying you ought not to be fooled by it either, and don't go pushing up rates because you start seeing some inflation, because we are not going to move our policy until it's sustained for a long period of time. And he is not putting a date on, Nick tried to get him to talk about, calendars. He's like, I'm not talking about calendars. I'm not going to talk about calendars. I've told you over and over again, I'm looking at the data. I'm looking at, sustained substantial improvement in achieving our targets, our goals. And if we don't see sustained progress on that, we need to be living in it, not seeing it coming, but living in it for some sustained period of time. Until that happens, we're not moving. And and so if the market is anticipating inflation coming, in even a burst of inflation, and they're expecting that will move the Fed, Powell he's using his mild-mannered voice, but he's shouting from the roof of the Federal Reserve building, don't be fooled, because we're not going to be fooled.
The one thing that it doesn't worry me, but I think it is mispriced. The market, I think a lot of DC people think that the Build Back Better is past, that we're getting another $2 trillion. And I just think it's going to be a lot harder to pass that one than it was this COVID. Biden was able to kind of keep everybody on board and keep out controversial stuff because we have a date. The March 14th, we need to get this thing passed in order for unemployment to keep going. The Build Back Better, we kind of call it an infrastructure bill, but it's really not. It's really an everything bill. And in that, there's going to be a lot of controversial, especially on the revenue side, the tax side. And a lot of these bills, especially, the wealth tax has nothing to do with raising revenue to spend. It's really much more about redistributing wealth. So, but I'm much more worried about the House than I am about the Senate, where you actually lost 2 votes for the COVID bill. So I just think it's going to be a bloody battle on the Build Back Better, where the COVID bill was pretty simple. I still think they can get something passed, but it's not going to be as much fun as this one was.
Yeah, you mean an infrastructure bill?
An infrastructure bill, yeah.
Yeah, I think so too. I do think they're gonna fight for it and push pretty hard for it. And I do think it's coming. I think, look, it's funny. One of the some of the criticisms of this bill that Republicans are raising are actually some of the kinds of things that should give comfort if you're worried about, bursts of inflation. They're saying, look, this bill isn't even going to be all spent in 2021, and we're going to be back to normal. It's actually going to be spent over 2022 and 2023 and 2024, and well, if you're worried about inflation and you're worried about sort of sustained fiscal support for the economy over time, that's actually more comforting than if it was all going to be spent in 2021 and some of those run hot concerns. It's still going to be a substantial amount of money being spent in 2021. No one should doubt that. But it does say that there is going to be support in the out years. I mean, look, I've been supportive of doing something big. Maybe I've recalibrated as to whether this big is needed right now. But if you're in the Biden administration, it is hard to get money through regular budgets, right? It is really tough. You've got annual fights with Congress to get money. They're going to be handed at least one big pile of money to support their initiatives and growth for, the remainder of the Biden term. It's amazing. Right. It is amazing. All the extra money that you might want to spend on all of your high profile priorities, helping states, helping unemployed, helping education, helping healthcare, right? It's like they're getting a pile of money to go do that. And then the next pile of money is going to be infrastructure. It's actually a pretty neat trick to turn if you're the Biden administration. And on top of that, you got the economy improving on its own. So, if you're just thinking about take partisan hats off and look at the projected economic outlook over the next few years, people are predicting a very big 2021. They may be increasing it based on the jobs numbers we saw today.
Some models actually put us at a higher trajectory in 2022, 23 than we would have been if we didn't get COVID.
It's kind of an easy.
It's not illogical. I mean, when you throw whatever $7 trillion at it.
No, with that much fiscal and monetary support, it's kind of. I mean, look, if the monetary support has a long tail. I mean, if you are borrowing money today and you are putting it to work in investments, it's got a long tail. So, it's kind of easy to make the case that we are looking at substantial elevated growth, job creation over the coming years, not just in 2021. All right, guys, let's take a break and come back and I want to talk about oil. You're listening to the Macrocast.
HPS is hiring. We are seeking a mid-level public affairs professional to join our dynamic team as a director in our Washington, D.C. office. Directors at HPS lead multiple client teams and internal projects and work in a fun, fast-paced, and challenging environment. The successful candidate has 5 to 7 years of relevant experience, is intellectually curious, and interested in public policy, in particular, the deep dive analysis that we do at HPS. To learn more about the position and opportunities at HPS, email our recruiting team at careers@hamiltonps.com.
Okay, we're back on the Macrocast. John, oil prices, bumping up after OPEC Plus. They're looking at restraining markets. How are you reading this?
Yeah, so we've been watching very closely as OPEC Plus, which is the collective OPEC and its allies, mostly Russia, and they have, during the pandemic, just to roll the tape back, they instituted supply cuts to keep oil prices elevated or relatively elevated amid the deflationary and collapse in demand. Very understandable. They took a huge amount of supply out of the market, and so basically that has continued to extend. They've managed to keep cohesion and discipline among the pretty fractious cartel and its allies over these months, even as oil began to recover. We got the good news in November about vaccines. We've got a brighter growth outlook that has taken oil up from the 40s to the 50s, now into the high 60s. And OPEC, normally at these kind of levels, you would get a fracturing of the cartel. You'd get cheating. You would get operators trying to capture market share, and the Saudis getting cold feet about the whole thing, because they're ceding market share to other members of OPEC or Russia who are pumping more. And we've seen that movie before. We've seen OPEC. I think it was late 2014 when OPEC had a dramatic falling out and couldn't hold together. And that really was a huge blow to oil prices. This has not been the dynamic. The enforcement of discipline that the Saudis have been able to achieve is very impressive. The ways in which they've gone to monthly meetings to assess their supply cuts, and in the last every meeting, it looks like this is the meeting where the supply is going to come back on the market. This is when Russia and Kazakhstan and the others come out and say, enough is enough. We've got, prices are high enough. We've got to start pumping again here. And every month, Lucy pulls away the football. The Saudis have come up with basically the same trick. Success, not the same trick. Actually, they came up with a unilateral million barrels cut the last time that they shouldered themselves in order to keep the cartel together. It's quite a performance, and they're playing a very and they managed to do what nobody expected them to do at the meeting this week, which was basically hold the supply cuts almost entirely steady with continued some exemptions for Russia and Kazakhstan, and boasting very high compliance ratios with those supply cuts. Oil prices have been on a tear since. There was definitely some cold feet. We saw 3 days of pretty steep losses in crude markets before OPEC, but they've all come out after yesterday. Prices vaulting higher, Brent crude going up towards 70, and the Saudis very specifically saying they don't think that this is going to elicit the same kind of U.S. shale oil response that we've seen in the past. And shale break even.
Why do they think? Yeah, why do they think that, John? Because we have seen it so often in the past, and one of the things that the shale industry has always said is just like how easy it is for them to react to to be pretty sensitive to prices in getting supply back. Did we misunderstand that, or they understand it better than we do right now?
Well, the Saudi oil minister opined that the dynamics had changed sufficiently in the U.S. shale market that the shalers were much more disciplined. They're focused on paying dividends, being profitable, rather than just going go, 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 drill, baby, drill. Yeah. That is, whether he's right about that or not, whether the sort of overhangs over the shale industry or the change in mindset of management, the consolidation of the players, the overhang of debt.
He might have a point. I mean, throughout, we didn't see a huge spike in defaults in the high yield market in the shale space. We saw some, but not what you would have predicted, 2 years ago, if you knew what was coming.
Right. And so we'd thought that the Saudis wouldn't be able to hold the line late last year, and we were taught differently. So in every successive meeting, we've basically, thought that our very tentative base case would be that this is probably the meeting where they loosen up. But we've had very low conviction in it, and the Saudis have come through every time. And so betting against them in the oil markets, if the Saudi oil minister says he thinks this is a real sea change in U.S. shale, I'm not going to contradict him here on our podcast.
Yeah,
so,
I think
we'll see.
Yeah, it seems to me like the things that have changed, sort of since then are. I still think there's a lot of incremental marginal production that U.S. shale can do to react to supply and prices. I think still, I still think that there's an acute short-term demand issue that's impacting them, and that is COVID and what do you think is going to happen with the movement of people in cars and airplanes for the next 18 months or so. And then there's the longer term rotation in energy sourcing that, like, if you think of, go back a year ago to today, the shift forward of the movement towards electronic vehicles, I think is it's a bigger story. And it's a much more near-term story than we would have guessed a year ago. And so I think that's, probably a bigger impact on U.S. shale production than something changing you can go back to Colonel Drake and his well in Titusville, Pennsylvania, right? And if you think like finally, oh no, now, and oil, gas producers have decided they're not rushing into demand. Like, you're crazy. We have 100 years experience on this. When demand is there, they're going to rush and go produce. It's the reason OPEC exists is because of that dynamic. And I don't think the psychology has changed among oil producers. I think their expectations for both the near term and longer term demand signals they're getting is probably a bigger it has a bigger impact right now. Guys, great show. Brendan, I don't know what we have next week. I didn't even think, I'm just thinking about the jobs reports.
Yeah, not a huge data week, but we do have an important ECB meeting. So that'll be really the focus of the markets and the policymakers going forward.
Actually, that's a great opportunity for us to talk about Europe next week. I mean, we've spent all day talking about the US. It might be worthwhile next week diving into the EU a little bit and see where they are relative to us, because at the end of the day, this economy might be roaring. It's not going to be roaring as much as we want unless the world is there. We've seen what's happening in China and Japan, but Europe is still super important right now. And we need to see and have a good sense of where they're going. All right, guys, great show. Great jobs day. Have a fantastic weekend. We'll catch you next week on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.